going into this year, we certainly saw the pricing was certainly quite recessionary in terms of the expectations, but obviously the hard data came in a bit better than expected, even if the softer sort of survey data was still sort of softish and muted. So it's been quite a hard sort of cycle to navigate, quite a tricky one to navigate. We're underweight equities. We have been since or before the summer. But I think the setup now is very different to the one we had at the beginning of the year. Certainly, as Ben has mentioned, with the higher for longer mantra and 2% real yields pretty much across the whole US curve, it's going to be hard for equities to sort of make sort of decent returns from here relative to bonds. And this chart sort of shows why. So what we've done here is we've taken effectively the earnings yield on MSCI ACWI equities. So that's the inverse of the Shiller CAPE, the Shiller price earnings ratio, and we've subtracted that concept from the 10-year real yield in the 10-year Treasury note. And as you can see now, from a multi-year perspective, based on our modeling, at these levels of difference between a pretty high real yield and a pretty low earnings yield in relative terms, this doesn't really bode well for the medium-term outlook for equities, especially in the next sort of few quarters, if not few years. So that entry point now, it doesn't look particularly good for equities, but it hasn't looked like that for a year or so. So I guess what we're trying to figure out here is what is a catalyst that's gonna drive those sort of rebalancing away from equities. We certainly expect a sideways move from here, but more of a pronounced downturn next year, and that's going to come off the back of that sort of slowing growth momentum and as you mentioned, as well as the lagged impacts of monetary policy, the lags being a bit longer in this cycle for the reasons that we could probably go into. But I think also the credit impulse is something that we look at a lot in strategy. It's turned negative for the US and the Eurozone, and it's poised to turn negative for China. And that certainly is going to have an impact on the global cycle, and therefore on the catalyst that we're looking for in terms of that rebalancing of equities away from bonds.